Hope everyone had a nice lunch.
Delicious.
We are back again and are going to spend the afternoon going a little deeper on a few issues. First, we're going to hear from Jake Feldman from Tax about the income-based education tax study that the tax department did. And then we will hear from Abby and Julia about the income-based education study committee. Both activities happened concurrently, which might not have been the most brilliant act of the legislature in the history of legislative acts, but we are going to make the best of it and hear from both of them. And I'm looking forward to it. Jake, if you want to come on up. Thanks.
Thanks. Jake Feldman, Senior Fiscal Analyst at the Tax Department. There's a report under my name on your webpage. It's got a very attractive looking homestead type property on the cover. So as the chair mentioned, we were charged with this report under Act 127 last year. It had about 4 components for us. And then there's the committee meeting over the summer that had the same 4 components and then 3 additional ones. The summer committees got more into the sort of the why or should Vermont do an income-based education tax, and ours was more technical in nature. Because it was happening concurrently, we kind of landed in different places. We were both asked about the renter credit, and the tax department sort of arrived at one spot and the committee arrived at another spot, which is fine. But I just say that because, we're happy to evolve with the conversation. So if there is a bill introduced, whatever it says, we'll respond to it. But we weren't able to respond to the committee's conclusions as they happened. The only part that I'm really going to talk about today is the executive summary, which is sort of the first couple pages of it. In general, our recommendation is to approach this subject with a lot of caution. Because anytime a state tries to do something with respect to taxation that's very different, there's a lot of risk involved. This would be quite a bit different. There's lots of states that have, progressive state income taxes like Vermont does. But in all those states, you have local property taxes paying for education coupled with state aid. There are states that have local income taxes. New York and Philadelphia are pretty famous ones. And then there's a lot of Rust Belt jurisdictions that have that, but they're not going to pay for education. And there's no state that has a state income tax and then a separate, slightly different state income tax for education. So that novel structure, it presents some risks. And so for more detail on the risks and the questions about should Vermont do this type of a tax, we could come back and present on that, but this doesn't get deeply into that. We did briefly look at National Council on State Legislatures Principles of a High Quality Tax System, which is what JFO has been sharing with this committee for basically tax design principles. And a couple of them really stand out with regards to the income-based education tax. The first one is a big one, and this is one of the principle of fairness. The question is it important that all Vermont tax type be progressive with respect to income, or is the progressivity of the overall tax structure what's important? Because if every tax type needs to be progressive with respect to income, then there's a lot of tax types which are bigger offenders than the property tax. The gas tax is deeply regressive. The sales tax is a regressive tax. The estate tax is a tax on wealth, but you would be surprised that the people who pay the estate tax actually have quite modest incomes in the years before their death. Should that be income sensitized? This is just me trying to say that, it's okay to have different tax bases. And that's a conclusion that the NCSL has reached too. But it is important that the overall tax structure be progressive with respect to income. Vermont's overall system is possibly the most progressive in the country. There's the Institute for Taxation and Economic Policy does a report called Who Pays, which is really helpful. It has California #1, Washington, D.C. #2, Vermont #3. But the data in that report is old, and they don't consider taxpayers over the age of 65. I think if they did, that we might be the top state in the country for progressivity. And the reason that's the case is because our current law income sensitized education property taxes are very unusual. There's no state that helps people with their property taxes as much as Vermont does based on income. And it's not even close. Maryland is second at around $3,000. Vermont provides up to $8,000 of income-based credit. And so I think to a large extent that's helping seniors. So very long roundabout way of saying that if ITEP had considered seniors, I think Vermont would maybe ranked even higher. That's number one. Number two, on simplicity, the Tax Structure Commission, which met not this past summer, but the summer before, I think, concluded basically on our education funding that our current system's too complicated. We need to go with income or property, and income better aligns with better flexibility to pay. That was in a nutshell their conclusion. But we don't think that going to an income tax would make education funding more understandable. You might know how much you got in an income tax refund this year, but the amount of your liability, you probably don't know. It would be something that you'd have to wait until very long after your budget vote to see. So when we talked about it in the tax department, we didn't see it as more transparent. We saw it as sort of burying education tax liability. So those were two principles that that stood out to us. The other thing is that, we've heard a lot, especially recently, that people feel like, Vermont's property tax system, education funding should go all the way to income because they're living in a house that's, larger than they need, but they want to stay there. And that's a fair sentiment from them. But it needs to be said that Vermont's current efforts to help people age in place, to help small households stay in large homes is already the most generous in the country and an outlier. And that has an impact. If you have your stock in your state of owner-occupied housing occupied by one or two, older people who don't work, then that has impacts across the economy and across the state's demographics. Your working age population would have nowhere to live, and your school age population would also decline. The school age population declining is what we're seeing. We're losing 1,000 kids a year. Our household size is shrinking faster than any other states in the country. And as of 2020, we're the smallest household size in the country, and that has an impact.
Representative Andrews?
I think it's also fair to say, though, even if we chose as a state to create policies that move older Vermonters into smaller homes or like right size them, that those homes don't exist either.
That is fair to say. Yeah. And there's been some articles about that recently about people who want to downsize, but they have, nowhere to go. So, that's not this committee, but it certainly ties in, but to what extent can people build those types of facilities in Vermont? Because they're certainly needed. That's undoubtedly true. Thank you. Okay, so that's a little bit of background. Some specific recommendations, and feel free to jump in if I'm too deep or if anything doesn't make sense.
Well, it's possible that there are people in this room that don't understand what the sort of big picture proposal that you're reacting to is.
Okay, thank you. So I'm so deep into it that
As am I, and so I just realized that.
So is there a big proposal? No, there isn't one. There was a bill introduced last session, S212, which basically followed the Tax Structures Commission. Their final recommendation, it's a tax on AGI. And it's like, that bill was like, you'd have, you pay your regular income taxes, but then you also pay an education income tax, which is a town specific rate times your AGI. So that's what that bill was. There is no bill that I know of for this year so far. But in general, what people are talking about is like town specific income tax rates based on your budget vote. And then you'd apply that to your adjusted gross income, AGI. That's the overall framework.
And I think Chair Kornheiser is probably talking about me when she's saying that.
Oh, no, I'm not. No, it's I'm
Um,
not. It's more than you.
Was the proposal that would supplant the property tax or be in addition to, or is it not clear?
No, that's an excellent question. So that would, in S212, that would supplant most of the homestead property tax. In that bill, if you were paying that income tax, your house site, which is your house and 2 acres surrounding it, would basically be exempt from the property tax, from the education property tax. And then if you own more than 2 acres, that would actually get pushed to non-homestead classification. So that's how that would work.
Thanks for that.
Is there more background that I should talk about?
I think that's good until we figure out something.
Okay, yeah, but thank you for stopping me because, okay, so the first part of our charge was talking about renters and how to make sure that they're fairly participate in the new system. Right now, renters pay for education sort of indirectly because they pay rent, and you can assume that part of that rent has got to be non-homestead property tax that their landlords pay. Their landlords are passing it on to them. So if there was an education income tax, you have a problem because they would potentially be paying this income tax and paying through their rent. And that's not fair to have them double taxed. So you have to either exempt them from the income tax or you have to give them back the non-homestead property tax that they're paying indirectly through their rent. So we looked at that and we thought exempting them from the income tax would be extremely complicated and unusual. There's not, most people pay income tax through withholding or estimated payments. And to introduce a part of that where it's based on your housing status would be really unusual and difficult because people's housing status changes. And there's no way that they're going to manage that with their employer. Like, oh, I used to rent, but I bought a home, so I got to go into my, human resources page and change it, whatever. So that seemed not likely. The second option we thought was probably better. So that would mean that renters are paying both things through the year, but then when the year ends, you try to give them all back that non-homestead property tax that they paid indirectly. It would cost a lot of money. We think it would be about $135 million. But that's sort of what you need to do to ensure that they're participating in the system. And since in the education income tax, it's the income rate that would reflect budgets. You'd want renters to be fully exposed to that if you're wanting them to be participating on the same basis as homeowners. So you just try to give them back the non-homestead tax they're paying.
Chris.
So if you are giving back that non-homestead tax, they would just be linked, kind of like they are now, to what property paid the income or the non-homestead tax? Then would you divide it by like bedrooms or something, or what would you?
That's a great question. Another instance of me like being too deep in this. So that's an option, but it would be hyper complicated. Because you'd kind of need listers to go to visit each apartment individually to see what it's valued at, and they don't do that now. So we're saying that if you were to try to give back that property tax, you just use benchmark values. Like the Housing and Urban Development publishes these area rent amounts, sort of a median rent. It's actually 40th percentile, but it's sort of like a median rent for the area. And that's what we use for the new renter credit system that we implemented last year. So the tax department is saying in this report that if you were to follow through with this, you could use those benchmark values to try to give back renters some of their the non-homestead property taxes that they pay. And then another important data point is that we looked at some multiple listing service sales numbers, and we think that 10% of rent is probably the number that is going to education property taxes. And then there's more detail on that, but that was the committee this summer was trying to figure that out, and like we didn't have the data on time. But that is our best guess.
You said 10?
Yeah. So
One.
I've got two questions,
Sure.
unrelated. I guess the first one is on the issue of sustainability and reliability, and maybe that's a question for Julia when she does her thing here, but just wanted to ask you if you guys had considered that at all, and that was something that you worked on, and
Yeah.
thoughts on that.
Yeah, so that's sort of part of the transitioning part of our statutory charge. The sustainability, reliability, we know what the homestead property tax base is going to be in the coming year with like near 100% accuracy. So it's a very known upcoming tax base. Income is more variable. Recently, income has been great. Like, I don't know if you listened to this e-board yesterday, but Vermont is getting a lot of personal income tax revenue, but in a recession, it could go the other way. So historically, there is a lot of variability there. And so you need to kind of buffer the education fund against that by probably increasing the reserve amount. It's right now it's at 5%, but you probably want to increase that. And we recommend that whoever is pursuing this talk to the treasurer about how much to change it.
Second question is kind of one more of sort of perception versus reality. And right now I'm always amazed when I talk to people in the district, how many folks don't understand that they're paying their ed tax based on income already. But they're filling out they're getting their tax bill from the town, they're writing a check, they're sending it to the town. Mm-hmm. They still very much have this idea that they're writing a check to the town and then their taxes are and then their school is being paid for. They don't understand that money then goes to Montpelier and decisions are made how to apportion it to the different towns, and then it comes back. And I'm just wondering if there was any thought to that whole disconnect in people's heads and whether it matters if you change the system now that they're just paying property tax based to the town for their town taxes and then paying a different bill to the state.
I think about those things all the time. And I was just thinking at lunchtime how the first thing that you said, how people don't even know they're paying based on income, is very true. You know, they go through their tax return on TurboTax or whatever, and TurboTax queues up these questions and fills out the forms for them. And then magically, they get a letter from the state saying you're going to receive a state payment, and that comes in June. And then on their bill, there's a little line at the bottom that says state payments. Is state payments the best name for that line? Maybe it should be like income-based credit, you know, because that might be better. But any effort to connect people to their budget votes is valuable. Ways and Means in 2018 did something kind of under the radar, but particularly brilliant, which is it used to be that your education and municipal taxes were all lumped together on your bill, and then you had a credit from the state. But Ways and Means separated those things out. So you have education, if you look at your bill, you've got education on one side, municipal on the other. And if you get a credit on the education side, it shows up there. And if you get a municipal credit, it shows up there. So that's an improvement, because at least now people can see how much of their bill, you know, clearly is education, and are they getting assistance from the state? So all those kinds of efforts are steps in the right direction. And I think would go a long way. So I talked about transitioning a little bit just now. The other important thing on the transitioning question is it would be very different tax format, and taxpayers, you don't want to catch them off guard. So the way that most taxpayers pay their property taxes right now is escrow. They make a monthly payment to their lender, which has their mortgage and their property taxes and their insurance, maybe other things. Excuse me. So it's in that monthly payment. And if you were to take the education property taxes out, they would have to change their escrow arrangements. You know, they would have to reduce it by that much. So that's a pretty big systems change. And then taxpayers also have automatic payments set up to their towns in a lot of cases, where they, you know, I guess have a direct connection from their bank account to their town to pay their property taxes. So that arrangement also would have to be, you know, changed. And so you need to give them quite a bit of lead time. You need to get the word out so that people know that this is coming. So those are the major transitioning issues.
So we have to wrap at 2. I want to make sure that we hear from Julia and Abby. And then if after these 2 overviews, we decide we want to dive deeper, we can have everyone back in and keep on diving.
Okay. Yeah, I think the last couple I could wrap up pretty quickly. We were asked about accurate modeling. The tax base that was proposed in S212 was AGI, adjusted gross income. It's quite a bit different than household income. I went through as best as.
Why do you mention household income? Household
income right now is what people get their property tax credit based off of. It's a long, detailed form. So AGI is something that the federal government has defined for their taxing purposes. Household income is something that is defined in Vermont. And it's quite a bit different. Since Act 60, it's changed quite a bit to sort of get at a better metric of fairness. And now there are lots of things that are included in household income that are not in AGI, and vice versa. And so I quantified those and in a few tables in this report. I
found that to be the most fascinating part of your whole report. I was thrilled by this.
Oh, thank you. I think probably like the big ones to know about are Social Security. Non-taxable Social Security is included in household income, but not in AGI. I won't get too deep on that, but for people on Social Security, they're going to have a non-taxable portion and a taxable portion. If they're lower income, it might be all non-taxable. But that's in household income now. It's not in AGI. That's a big one. And then there's types of bond interest income. That's another big one that are included in household income, not in AGI. But anyway, it's quite a bit different. And so you'd create some winners and losers that you should know about by switching tax basis. The last part of our charge was about administering the new tax. It would have to happen at the state level because towns can't administer an income tax. They're not equipped to do that. They do benefit right now from administering the homestead education property tax. They get to keep some of the revenue from it. They get to keep what's called float, which is interest that's earned on the money in their accounts. And they get penalties and interest on delinquent taxes. So there's some fiscal ramifications for towns if they were no longer collecting the homestead education property tax. The League of Cities and Towns and municipal clerks and treasurers might have more information on that. And then there's another issue is like with income taxes, if you're really low income, you actually don't have to pay income taxes. And the thresholds are like basically if your income's below the federal standard deduction amount, you don't have to pay income taxes at the federal level or in Vermont. So if you were doing an education income tax, you'd have to think about like, what about those households? Do they have to pay? And if they did have to pay, then you'd have to reconstruct AGI for them because they don't have an AGI to pull off their federal form because they don't have a federal form. So that's kind of awkward. It's like having very low income people having to fill out a form that everybody else doesn't have to fill out. So those are some takeaways from the report.
Thank you very much.
You're welcome.
I recommend reading it to folks. Grand scheme of reports. Thanks, Jake. So I'm sorry to say, team, that we have a hard stop at 2:00. And so I think what we're going to do is ask you to do a overview. Fortunately, we already did some ed tech stuff last week, and so maybe we'll be prepared for it. And then if committee members have their appetites whetted and have read the reports, then we can dive back in after we've all read the reports to ask more questions.
Great,
Thanks.
thank you. So for the record, Abby Shepherd, Office of Legislative Counsel.
I'm Julia Richter with JFO.
And we're going to tag team it because we were the staff who worked with the committee over the fall, but we are nonpartisan staff, so none of the recommendations in the report are our individual recommendations. We are here to just give you an overview and explain what was considered and what was ultimately recommended.
By the committee.
By the committee, thank you. We'll try not to finish each other's sentences. So I will go over the enabling legislation and the charge, which is slightly different from the other study committee that looked at similar questions. We do want to again highlight that what the committee did recommend was based on if an income-based education tax were enacted, how it would be structured. The committee made a conscious decision not to look at if that should be enacted. That was left to the discretion of the legislature. So looking at the enabling legislation, I won't go through every detail, but just so you know why this came about. The study committee had both, it was an entire legislative committee, it had both House and Senate members. The charges were looking at if an income-based education tax were imposed, how the existing renter credit should be restructured to adapt to that, transitioning from the current system to a new system based on income tax, accurate modeling, so similar to what the Department of Taxes report looked at, given the differences between different types of income, whether there should be a limit to income subject to an income-based education tax, administrative challenges, taxing capacity for the state, particularly if there is a personal income tax, an income tax that is going entirely to education, how that would impact the personal income tax and the general fund, given that personal income tax goes to the general fund, and then a catch-all for any other relevant considerations. So again, as I mentioned, we were the staff people from JFO and Legislative Council. The administration in the form of Jake Feldman primarily did also testify, as well as some folks from AOE. So it wasn't only us that were being heard from, but we did provide the legal and fiscal analysis. So try and keep it brief so that Julia can talk to you about some of the more fiscal side. The recommendations that were made were, as Mr. Feldman did point out, were slightly different. Again, this was only if an income-based education tax were enacted, how it would or should be structured. The committee did consider making changes to the existing property tax credit and decided to move really to focus on how an income-based tax would be structured instead of changing some of those current parameters that set the property tax credit. There were also some sort of unresolved issues, outstanding policy decisions that were not addressed, and I'll mention those briefly. So the primary recommendation that came out of the committee would be creating an education tax structured with progressive marginal rates, so to get at the progressivity concern, and with income brackets on AGI, so adjusted gross income. So you're moving away from the household income metric and looking at adjusted gross income. As was just discussed, that is a federal metric and a federal definition, and that would apply to all Vermont taxpayers, so both resident, non-resident, and part-year resident in the way that personal income tax applies. It would also take into account there are constitutional limitations to taxing non-residents, so those would be incorporated into that tax structure. In terms of the rates and how those would be set and adjusted, those would apply by school district. They would increase or decrease according to local spending decisions. So the committee did consider impact on local voting decisions and also maintaining local control over spending decisions. That would be set based on prior year's education spending as well. It would that adjustment would be a comparison between prior year and the current year spending decisions. Much of the recommendations in terms of setting tax rates were to maintain the current structure in terms of who sets, there would no longer be yields, but there would still be a similar process looking at all of the revenue streams in the education fund, and that would impact the rates that would be set. So there would be local education spending decisions. There would still be a commissioner's December 1st letter, and then the General Assembly would set the actual rates. And I'm saying rates plural because the non-homestead tax would still be retained. So within a new income-based education tax, the mechanism for paying would mirror the current personal income tax payment. So there would need to be a mechanism for withholding payments on wages and estimated payments. So for self-employed individuals or any form of income that is not subject to withholding. So those are really the big grand outlines of how that education income tax would be structured. The other tax types and issues that were addressed are the renter credit and then the property tax. So I don't think this committee has had a deep dive yet into the renter credit. No. So there is an existing renter credit. It functions more like a benefit program. It is now sort of divorced from the homestead property tax credit. That program would be maintained under this recommendation. A new non-refundable credit would be created for all renters against the education tax that's based on income, and the committee recommended it be structured as a percentage of total or gross rent paid. So that would be a new credit for renters because the non-homestead property tax would also be retained. In that situation, renters would be paying both on their income and the non-homestead property tax. That was the reasoning for proposing to create a credit so that renters aren't paying twice into the education fund in two different taxes. There was a similar recommendation to S212 from several sessions ago was mentioned earlier. A similar recommendation came out of the committee to maintain the non-homestead property tax, but it would have a larger tax base, because individuals with homesteads would be exempt. There would no longer be a homestead property tax. However, if a homestead was larger than 2 acres, that larger parcel, so if it's 8 acres, 2 acres would be exempt from tax. The remaining 6 acres would be subject to non-homestead property tax. That is the extent of the several sort of moving pieces for a new income-based education tax and the non-homestead property tax. Also, because the homestead property tax would be repealed, the property tax credit would be repealed. The other considerations were changing the stabilization reserve, which is currently within the education fund. That was one consideration, would be to increase it potentially for any increased volatility because of the income source for the education fund, just to deal with those potential fluctuations there. Education payments and the cash flow to districts would be maintained. And lastly, the administration of the property tax system, which would become purely a non-homestead property tax, would remain with municipalities. And then there are a few other outstanding sort of concerns that were recommended to be dealt with by the legislature as really needing some more deeper dives into the policy side and the should. But I don't want to cut off time left for Julia to make her few points. I'd be happy to come back or answer any questions.
Thank you. Abby just provided an excellent overview of our fall. I don't know if it'd be helpful for me to go into any of the specificities, or Chair Kornheiser, if you wanted to open it up to specific questions. Did you have a
I think if you could take us through just a little bit of the modeling that led us to the recommendations, that would be helpful.
Sure.
If that feels possible in 7 minutes.
Yes, definitely.
Use my agenda.
So the committee looked at a lot of modeling that we put together. And one of the first requests that we had was to consider adjustments to the property tax credit. So adjusting the current system to see if adjustments to the current system could achieve some of these goals or desired outcomes of both increasing simplicity as well as increasing fairness. And so you do have the report in front of you. This is section 4, but big picture, what the committee asked for was really 3 areas to be adjusted. So when looking at the current net property tax paid as a share of income, when you look at it, that's not a smooth progressive curve. And so the committee wanted to see, okay, looking at that chart, how can we adjust the cliffs and bumps for people with lower household income that currently qualify under the circuit breaker, the quote unquote hump after that household income threshold of the 90,000, as well as the really low effective tax rate paid by the taxpayers with very high household income. So those were the 3 areas that we were asked to adjust in the modeling. And I can certainly point you towards the slides of all of the modeling results, but really the big picture that came out of that were sort of two big pictures that my former colleague Graham Campbell named pushing the balloon and the sledgehammer. And I think that that's a really helpful way of thinking about this. The first, pushing the balloon, when you make one adjustment in the education fund, that adjustment is inherently going to pop up somewhere else, right? So when we adjust those cliffs down by the circuit breaker, adjusting those to have that smooth progressive slope that the committee was looking for is then going to pop up elsewhere in the distribution. And so trying to address those three areas that the committee asked us to address led to 4 pretty large, distinct policy changes that would need to happen. One of those changes alone would not be able to achieve any of the committee's goals. And then the second part was the sledgehammer, quote unquote, effect, where it's really difficult to achieve specific desired effects because it's not necessarily the most nuanced policy lever, because by adjusting different thresholds, you're essentially shifting tax liability within all of the different income ventiles, dependent on their relationship of household income and house site value. And so that's a 2-minute summary of these pretty long modeling exercises of looking at how can these areas be adjusted. And they are big picture takeaways. So even if the committee were to have asked adjusting the property tax credit in a different manner, these big takeaways would still apply.
Cool.
Oh,
Questions, thoughts? Okay. Thank you very much. And again, if folks want to read the 2 reports and then have more testimony, please let me know. So with that, we will thank you so much, both of you, for all of your work this fall. It was a huge project. And I think worth reading the whole report in order to get your head around it. So we are going to slowly transition our way to joining the Appropriations Committee and the Finance Committee at 2:00 via Zoom. Again, we're going to get an hour-long presentation on the RAND childcare financing study. Encourage everyone to take notes about your questions because there's going to be no time for questions during this. It's just a straight presentation. And then we're going to have time for questions tomorrow.
At 11.
At 11.